Well, good morning, everyone. Thomas Montgomery. It is Friday, September 1st, 2023. We get together with our distribution partners and now our clients each weekday morning, or most weekday mornings. We won't Monday for Labor Day, but we get together to talk about strategies, tips, techniques, share success stories. We may have a brief topic to address and then move it to open forum to answer questions, concerns, comments that each of you may have. Today we have a really good topic, and it's on equity-based capital raise. So I think so often we only think about debt. How do we help small businesses take on debt, take on lots of debt, where they have big payments? That can be a problem for some small businesses. There's a different way. I'm not saying a better way, but there's a different way to get capital to start or grow a small business, and it's based upon equity. So that's what we're going to talk about today, is how to leverage an equity-based capital raise for small businesses. So with that, let's begin with what exactly is equity financing. Equity financing is the process of raising capital through the sale of shares. So we're not borrowing money, we're not taking on debt, we're not promising to have to pay money back, but we're selling some of our business for a capital injection. Let's read on. Companies raise money because they either have a short-term need to pay bills or they need funds for a long-term project that promotes growth. By selling shares in their company, a business can effectively, although they reduce their ownership, they're able to get an influx of cash. And again, as we mentioned, it doesn't have to be paid back. It's not a debt. We're not talking about private loans. We're not talking about private lenders. We're talking about equity finance. So there are some key points about equity financing we should go through. Equity financing is used when companies need cash. So in other words, you wouldn't just go out and, you probably wouldn't, go sell shares of your company if you didn't need cash. You'd probably hold on to those shares. But one way that many companies do, and some will do a combination of debt and equity, which we'll get to in a moment, but we may sell some of the shares for an influx of cash. It's typical for businesses to use equity financing several times. So it might not be that we just have one tranche of equity injection. We might repeat that several times. And I'm going to give you a success story that we were involved with of how that has happened in a moment. There are two methods of equity financing. Primarily what you and I will be dealing with is the former, the first of the two, a private placement stock offering. So that is less regulated, less restricted, and frankly, pretty easy to do. In contrast, there's what you hear about in the news, a public stock offering, an IPO. That's a very complicated, very regulated, that's a big deal. That's frankly not what we're involved with. Now, we could certainly help clients with the initial private placement of stock, and that might be a step towards a larger public stock offering, but we help with private placement of stock very successfully. We don't in-house do public stock offerings. As you might expect, equity financing might be a really good choice for those businesses that want or need money now, but they don't yet qualify for debt financing. Because remember the 3 C's, credit, collateral, capacity, that's what we need in general for debt, but we don't need the 3 C's for equity. See, it changes the rules of the game. It's a different recipe. Equity financing can be used to raise a small amount, or it can be used for very large amounts. So it's very flexible. So you can't think, oh, what I need is too small. Equity financing wouldn't work. That's not necessarily true. Some investors are looking to put small amounts in. Conversely, you can't say, oh, I need so much, equity wouldn't work. We can either pool together investors where there's multiple investors bringing in money, but there are some investors that only want to do big deals. It's kind of like dating, forgive the analogy, but when you're dating, and you use a dating site, men and women have different preferences. Well, investors have different preferences. Some investors want small deals, some want large, some like new companies, some only want established. So there's not a singular answer. It's meeting the appetite of the given investor based upon what you're needing or what your client's needing. So one more time, let's just differentiate the two, because I don't want to leave today's training without us understanding the very clear difference between equity financing and debt financing, because we can help both. The client enrollment process, credit and funding is the same. So don't be confused by that, but I just want you to understand the difference again between equity and debt. So businesses typically have two options for financing when they want to raise capital for business needs: equity and debt. Again, we could do both. But debt financing involves borrowing money, taking on debt, money that they have to pay back. Conversely, equity financing involves selling a portion of the equity in the company. While there are distinct advantages to both types of financing, many companies will use both. And that's probably what you and I will start talking about, is looking at a combination of strategies, which might be best for the client. And if so, obviously that can result in a higher capital raise, and the higher the capital raise, the more money you make. So now, instead of thinking about $100,000 capital raise per client, we might be looking closer to $1 million capital raise per client. All right, well, how does equity financing work? It involves the sale of common stock and other equity. A startup that grows into a successful company will often have several rounds of equity financing as it evolves. Since a startup typically attracts different types of investors at various stages of its evolution, it may use other instruments. So that's a little complicated, but what does that mean? Often we'll do multiple rounds of equity financing if that's what the client wants and desires. And it will very well maybe with different types of investors as the business grows. The first question we have is from Timothy, and Timothy's asking, can pre-launch, pre-revenue businesses leverage equity financing? And the answer is yes. All right, so ultimately we need to understand what it is that you and I do to help clients with equity financing, because this is a big deal. So businesses will need a package to present to equity investors, and that's somewhat like what they need for lenders. We call it a loan package when it's for the purpose of acquiring debt. It's positioned a little bit different when it's for investors, but it's still a package. The package would include things like a business plan, historical financials, and I understand maybe the business is so new, there's no historical financials yet. Financial projections, obviously very important. Financial projections are important for a debt-based capital raise, but I would argue even more important for an equity-based capital raise, because this is really what the investor is wanting back, is a share of future profits. So we need to be able to show them when and where the profits will come from. The strength of the package for an equity-based capital raise and of the business itself impacts the business's valuation and the cost of capital raised through equity financing. So what do I mean by that? Well, all capital is going to have a cost. It's rare that we get free money. Free money would be like 0% interest with no finance charges. So that's what we call free money. Not meaning it doesn't have to be paid back, but there's no additional cost other than just the amount borrowed. When we get into the equity side, what we're doing is we're making a calculated decision of how much ownership of the business we're going to sell off and how much capital we want to raise from that. So the value of the business, of course, would impact how much equity we're going to sell to get that amount of money in the door. And we'll help with that, so don't worry. But the bottom line is, from your and I perspective, it's the same on the front end. The credit and funding program is effective in creating the package we just talked about and getting it in front of investors. Currently, we have access to about 250,000 investors, and these are all different people, some from the US, some from outside of the United States. And again, they have different appetites. Some like certain industries, some like certain locations, some like certain phases of the business evolution as far as pre-revenue versus mature. It varies. Each investor has their own palette for what they're looking for. But the great news is our investor platform, since 2004, we've raised over $300 million. So it works. It absolutely works. And we have investors right now looking for businesses to invest in. So a quick success story. And so this is a real one that we facilitated. The most recent private placement we facilitated was for an initial $400,000. So $400,000 is what the business needed. And it was enough for an injection to take this business and take it to the next level, to market, to have more working capital, to hire more staff. But with the 400,000, you see that, that's not multi-millions, but the business didn't need multi-millions. But obviously, it's a lot more than this company would have qualified for through debt-based financing. The company itself was an early stage health and wellness business based in McKinney, Texas, which is outside of Dallas, Fort Worth. The investor that we paired them with is, his name's Jeff, CPA out of West Texas, very sophisticated individual, both at an accounting firm, and he and his wife, Sarah, owned a home health agency. So we facilitated that, and the investor, Jeff, wired the 400,000 to the client. So, I mean, this actually works. This is real. This is not just talk of, oh, it could work. It does work. Now, afterwards, the client needed additional capital, and we were able to facilitate, going back to, in this case, to the same investor, several additional subsequent rounds of funding. And literally that money is wired from the investor into the client's account. So what's the key to the deal? Well, what was the key to this deal, but probably true in general, is we need strong forward-looking financial projections to show that the business is going to grow, be profitable, so the investor is going to get a positive return on investment. And also, we want to have a strong balance sheet, because this business here was an early stage business. And so it organically didn't have much collateral like a lot of small businesses don't. But we're able to use our collateral support program, add legally and ethically, add collateral, add assets to the balance sheet that then gives investors confidence, because even if the business doesn't succeed, there is collateral to help the investor recoup what they've put into the business. So with that being said, there's really two ways to get involved if you have an interest in equity-based financing. First, if you know of any businesses that's looking to raise capital, whether it be through debt or equity, they're looking for at least 100,000. They want that guaranteed. Obviously, we can help them through the credit and funding program. We just need to get them with one of our branch managers, and we can make that happen. Secondly, if you are an individual and you'd like to help businesses improve financial literacy and raise capital, you are welcome to become one of our private label branch offices. Not get rich quick, not Ponzi, not MLM, but it's a good, honorable side gig. And that's what it is for most people. Our private label branch offices generate on average $12,000 per client referred in. Most of the branches, not all, but most of the branches will do a deal a day on average over a month, about 30. So it's a good six-figure side gig, but it's not life-changing. It's not like winning the lottery. It's not anything extreme, but it's fun to help people, and it certainly is a profitable side gig. So let's open it up for the questions, comments, concerns, because what we want to do is make sure that we're allocating time to each of you. Since we did have a topic here today, I will ask if you can focus your questions or comments today on specifically this topic. And then next week, we'll go full bore into just open forum so we can talk about anything and everything. All right. Sarah's asking about Monday. Yeah, we're closed Monday. Monday's Labor Day, so no Zoom on Monday. But who has questions on this topic? On this topic. All right. Jim's asking about pre-qualifying. I don't think that you need to pre-qualify. If you can run into an entrepreneur that's looking for funding, just get them enrolled in the credit and funding program. Get them set up the way we've taught you to. We need an agreement, their initial payment, which is paid to you, their PFS, and their soft pull. Those 4 elements create a client file. At that point, then you and I, we can start working on the client's profile, their funding plan. So if they want debt, great. They want equity, great. They want a combination, fine. Maybe they don't know, that's fine. But you and I will do work on a client once the complete client file is in-house, because your time is valuable. You're smart. There's other things you could be doing with your time. So until the client's on board and has signed a contract with you, not with us, with you, until they've paid you, not us, you, until they've contracted with you, paid you, soft pull done, and PFS, there's no work to be done. That's the core set of items that we need. And then you and I can roll up our sleeves and get the client from here to there. Ken asked if this is just for US based companies, and actually it's not. No, this can be done globally. So no, there's really no filters that you need to place other than it's a legal based concept. You know, if they're looking at fentanyl distribution, we can't do it, right? Child trafficking, not going to do it. So as long as it's legal, then we're good to go. You don't need to filter on location or industry. As long as it's legal, time and business credit, none of that matters, just legal. And then get their file set up. Okay, who has other questions, comments, concerns on this topic today? We'll move to full open forum next week so we can address A to Z, everything that you want. But this has been around, this has existed, but we probably haven't brought enough attention to it. And so today's purpose is to create awareness. So, you know, here we are on September 1st. Our goal, our clear goal for every one of you that's already set up as a branch is to help you generate at least 100,000 in the month of September through your branch. So we definitely want to accomplish and get you to at least 6 figures. So this is just one more arrow in your quiver that could help us reach that goal. But you've got to enroll clients in the capital and funding program. You need to get their initial deposit. Either they pay the refundable setup fee in full, or they pay a $250 down, and then they finance the rest at 0%. You got to get that PFS completed. You need to get the soft pull completed. So we are committed to helping each of you have 100,000 this month. Even if you just started yesterday, even if you just signed up today, this is our goal, 100,000 in September. So we need to take action. Who needs help in getting started? And of course, you have our normal contact us information. Because as you come aboard as a branch, first thing we're going to do is send you a branch onboarding email. On the branch onboarding email is the editable client agreement. You're going to take that, you're going to edit it. You're going to put your name, your branding on it. If you want to change pricing, you can. You can change the other terms if you want, but you don't need to. And get clients under contract, then get the payment, either get the full payment, whatever you're charging for the refundable setup fee, which is again refundable to them from the grant, or at least get the $250 for the down payment. If they're doing the down payment, you need to get them to sign the $1,750 financing agreement, 0% interest. They pay $250 a month in the first of each month. Then we need to get that PFS done. We've had dedicated specific training on showing you how to complete the personal financial statement. And then thirdly and lastly, the soft pull. That's got to be the focus. If you can do those things, then the rest will come together. If you don't do that, we probably won't be successful, but we're here to help you be successful. So any other questions on this topic? So Fu's asking a question, and it's kind of related, so we'll go with it. I feel like he's kind of asking about the role of credit in equity-based financing, and that's a great point, Fu. credit is less important, especially personal credit. Business credit's still very valuable, but personal credit is less important for an equity-based capital raise than for a debt-based capital raise, for sure. Bernard asked, if it's not a US-based business, is the setup the same? Well, that's a good point, because the soft credit pull, well, we get two different things. Is it a US-based business or not? And is the ownership US citizens? You could have a foreign business with a US ownership, and then it would be the same because Social Security numbers would apply. But if you have a client that is from Somalia, they probably don't have a Social Security number, so they probably don't have a US credit profile, so we would skip that. That's a good point. But the personal financial statement would still be relevant. Certainly when we're doing an equity-based capital raise, we're going to be looking a lot at the business's financials. So it's more about the business's credibility, which we're very good at building, less important about the business owner's credibility. Where debt-based capital, especially for early stage businesses, is much more reliant on the credibility of the business owner or owners themselves. All right, well, our commitment is to keep it a little bit shorter on Friday. So here is the topic of the day. Really, the only takeaway is just simply be aware that it's not just debt that you and I can facilitate. If people want money to start or grow a business and they want money they don't have to pay back, that is available. And we call that equity-based funding, equity-based capital. And we went through a rundown of how it's different and how it's positioned. But the great thing for you is it starts the same. Get the client enrolled in credit and funding. We'll figure out and create a plan for the capital raise for each client once they're a client. If they're not a client, we're not going to spend time talking to them or planning or reviewing data or creating documentation. They need to be a client first. Awesome. All right. Well, thanks, everyone. Have a great Labor Day weekend. We'll see you back Tuesday morning. Bye-bye.